What we're going to be going over here is the direct labor rate or price and efficiency variances, and it's going to be based on a standard costing system with a flexible budget. Okay, so let's look at what we're talking about here, and I have it laid out in a table form here. So for variance analysis, we're going to really be dealing with three different sets of numbers here, or budgets. We're going to have our static or our standard budget here, and then we're going to have our actual results that we have here for the period. And then comparing our static with our actual results, we come up with this flexible budget that we'd be looking at here. Okay, so let's first look at, we first start with the static or our standard amount here, and that's based on our budgeting at the beginning of the period that we'd be looking at. And that's really taking for a product here, a company establishes a standard that they allow for manufacturing a certain product, and we're going to be looking at the labor standard that's allowed. So they have a certain budgeted quantity of labor that they would allow at a certain budgeted cost. And really what we're talking at is a standard amount that's allowed. So for our case here, this is where the standard is really used for the budgeting inputs. The company sets a standard here on how much labor they'll allow for manufacturing their particular products. Okay, so we established that here at the beginning of the period here. And then at the end of the period here, well, we know the actual costs that were incurred here for the period. In this case, we're looking at those labor costs. This is where you take your actual input quantity and you take it times the actual cost or price. Okay, so now we know our actual and our standard or our static amounts. Now we can determine our variances based on the flexible amount that we allow here. And the flexible amount, that is really taking our actual input quantities here that we had for the period here. And again, this is determined at the end of the period here. So we take our actual input quantities that we have in this case for the labor times the budgeted cost or price. So we're taking our budgeted price off our static budget and taking our actual inputs, or what we used here, off the actual amounts that we had for the period. And we make that comparison here between those and the overall comparison between the actual and the static amounts as well. So this is what we're looking at when we're talking about the flexible budget. Okay, so let's go down and let's look at it here for our direct labor. So first dealing with our rate or price variance. Really, that's again looking at our actual versus our flexible amount here. That's where we would take the difference between the actual rate here, the labor rate that we have for the period, difference between our actual rate and the standard rate that's allowed. And that difference we take times the actual hours used. Okay, so that was for our rate or price variance. And then for efficiency variance, this is where we're comparing our flexible amount to the static amount. This is where we're going to take the actual hours used here, the difference between our actual hours used and their standard hours allowed, that difference times the standard rate. Okay, so that's for our looking at our two different variances that we're going to be going through here for our labor variances here. And we're going to go through a problem here using those, calculating these. But before we do that, let's first go over and look at our diagram over here. So if we're looking at our total profit variance, and that, well, it's really divided up here between our sales volume and our price or cost or our flexible budget amounts here. And we're going to really be dealing with our flexible budget amounts. And under that, we have our unit cost variances here and, of course, sales price variances. But under our unit cost variances, this is where the direct labor comes into play here. So a unit cost, I guess we have our direct materials, our direct labor, and then our overhead variances. So we're going to be dealing with the direct labor variances in this case. So we'll continue on with our example. What we're going to be going over here is direct labor rate or price variances here, and also looking at direct labor efficiency variances. And we're going to be calculating these. And it's going to be based on a standard costing system. So what I've got that showing here is I've got it showing in T account form, and we're going to track these labor costs through our different T accounts here. And first, for a conceptual overview of what's going on here. Say, for example, you're managing a particular manufacturing department, or you're looking at a particular project that you're tracking here. And what you want to do here is we'll start with the case here where you're going to accumulate some wages payable here at their actual cost for this particular department or this particular project you're looking at. And then those wages payable are going to be transferred into a control account here for a manufacturing control account here. They're going to be coming in at their actual cost here at a particular actual hourly rate here and the actual hours that you use for the particular period you're looking at here or this particular project. And then they're going to be transferred out of your manufacturing payroll account into the work in process account here at a standard cost. And what we mean by a standard cost, they're going to come in at a standard rate and also based on the standard hours that are allocated for the particular project or the department you're looking at. So there's going to be a difference here between your hourly rates here, your actual hourly rates and your standard rates, and that's going to be going into your direct labor rate variance based on actual hours used. And then for the difference between your actual hourly hours used versus the standard hours allocated, that times some standard rate, that's going to go into your direct labor efficiency variance. Okay, so we'll go over our calculations here, but before we get into that, let's just go down and look at our key of what we're talking about here. The AR here in red stands for actual hourly rate here. SR means the standard hourly rate. AHU here is the actual hours used, and SHA here is the standard hours allowed. Okay, so let's go through our example here. So we'll start out with our wages payable. Again, this is a control account, and it'd be the actual cost here. So say, for example, for the month here for this project, we accumulated here wages payable of $62,115. So that's the actual cost that we have on wages payable. And that's going to be transferred in here. A credit to our wages payable is going to be a debit to our manufacturing payroll control account at the actual cost again. So the $62,115, that's based on our actual rate here, actual hourly rate here of $15.15 per hour times the actual hours used here, 4,100 hours. So those $15.15 times 4,100 hours is going to give you the actual cost here of $62,115. So now we're going to transfer that, our actual cost here, the $62,115, credit your manufacturing payroll by that amount, and it's going to be transferred into work in process, a control account at the standard cost. Here we're going to not record the actual cost that we have, but it's going to be based on the standard cost that was set here based on that that project that we're looking at, and that's going to come in at could be debited here for $60,000. So you can see there's a difference here between what you're transferring out here, the actual cost of $62,115. It's coming into the work in process account here. We're going to record it at the standard cost of $60,000. So we have to account for that variation here of what? $2,115. So first off, for our work in process, our standard cost, how would we record it here? This is where you take the standard hourly rate here, and in our example here, the standard hourly rate should have been $15 here. That's what we budgeted for, and that's what we calculated here as our standard rate, times the standard hours allocated. For that particular job or department here, we allocated 4,000 hours. Okay, so $15 times 4,000 hours is going to give you the $60,000 here. So that's our standard cost versus our actual cost. Now let's figure out our variances here. So starting with our direct labor rate variance here. So you can see here, that's based on our hourly rate here. Our actual rate here per hour was that we actually had for our cost here that we accumulated at that is $15.15. So our standard rate, that's what we budgeted for here, or that's what we allocated as our standard rate, was $15. Now, our labor rate variance is really the difference between our actual versus our actual rate here versus our standard rate times the actual hours used. So let's go down here and look at that. So what we would do here is we take our actual rate here of $15.15 subtract our standard rate from it here. The difference here is $15, or what would that be? $15 here. So the difference is 15 cents on an hourly basis times the actual hours used here, 4,100 hours. So that's going to give us $615, and we would debit our direct labor for that amount here, but $615. Now that's when we talk about debiting here, that means it's an unfavorable labor rate variance. And the reason that is because our actual hours that we used, our actual labor rate here was $15.15 per hour. But that is greater than our standard labor rate here of $15 per hour. So this is where we get that. I'm showing it as U here is in unfavorable. That means is we had to pay, or our cost here for the actual labor rate is greater than our standard cost here we had established. Okay, so that would be the unfavorable case here. Now, if the opposite was true, where our actual labor rate here was less than $15, we would have a difference here where our direct labor rate variance would be favorable. We would have credited or reduced our direct labor rate here by the difference, or by the, say, the actual rate here would be less than our standard rate that we had established. Okay, so that's our direct labor rate variance. Just remember, it's the actual rate on an hourly basis here less our standard rate here on an hourly basis times the actual hours used for the project or for the month here. Okay, that's direct labor rate variance. Now, the other thing is our direct labor efficiency variance, because this is where that comes into play. So this is the case here where you're going to take your actual hours used here and compare it to your standard hours allowed here for the case here. So take the difference, the actual hours used here, 4,100 hours times the actual standard hours allowed here, 4,000 hours, is going to give you what, a difference here of 100 hours here. In greater hours here, the usage was 100 hours more than the standard hours allocated, times your standard labor rate here, per hour basis of $15. So that gives us what, 100 hours here times $15 is going to give us $1,500 here in direct labor efficiency variance. And just remember that, again, we're debiting it here, and that's going to be unfavorable here because your actual hours used here, 4,100 hours here, is greater than your standard hours allowed here at 4,000 hours. So that's where it's coming up unfavorable again. Now, it would have been favorable here had we actually used less hours. Say our actual hours used, say, would have been 3,900 hours here versus our standard hours allocated here at 4,000 hours here. So the difference would have been going in as a direct labor, as a credit here, a reduction in our direct labor efficiency variance here. And that would have been a favorable cause here. So just remember, when you're talking about these variances here, in both cases here, for direct labor rate variances versus your direct labor efficiency variances, any debits are unfavorable because that's where your standard cost is, or your actual rates or your actual usage here is greater than whatever your standard cost would have been established at. So debits are unfavorable, credits are favorable in both cases here for labor rate variances and labor efficiency variances. So if we go back to our case here where we had that based on our standard rate and standard hours allowed here for the particular project or department, you can that $60,000 here versus $62,115 here. The difference, again, the debits and credits here were split between your direct labor rate variance here. That included $615 here in direct labor rate variances, plus the direct labor efficiency variance of $1,500. So what is that total here? $2,115. So that accounts for the difference here between your actual cost here and your standard cost here of $2,115. $62,115 versus $60,000 here in your standard cost. So just remember here, when you're working with these labor rate or these labor rates and efficiency variances, all you're really doing is comparing for your labor rate variance, you're just taking your actual hourly rate that it cost you for the period here or for the project and compare it to the standard labor rate here that was established based on some standard costing here. The difference between the two times your actual hours used here equals your labor rate variance, either unfavorable or favorable. And for your direct labor efficiency variances, that was based on actual quantities here or hourly amounts. So this is based here on your efficiency is based on the actual hours used, compare it to the actual hours allocated times the standard rate here, hourly rate here. That gave you your direct labor efficiency variances. So the efficiency variances is based on some hours that you've either had actual hours used and versus your standard hours allocated times some standard labor rate. So this is really quantities of hours that you're looking at here, and times some standard labor rate versus your direct labor rate variance. This is where you're looking at the cost on a per hourly basis times some standard or some actual hours used here. So you can see direct labor rate is based on the standard hour or your hourly cost here, and your efficiency variance is based on hours used or quantity of hours used here. Okay, so let's just go over these accounts one more time here so you understand what's in them. So if we're looking at our direct labor efficiency variances, that is your actual hours used here. And you would subtract your standard hours allowed here times your standard rate on a per hourly basis. Actual hours used minus your standard hours allocated times some standard rate or some standard hourly rate that you're looking at. So that's your direct labor efficiency variance. And then for your direct labor rate of variance, that's your actual rate on an hourly basis minus your standard rate on an hourly basis times the actual hours used. And then moving up to our other accounts here, our wages payable. Again, that was at a control account at the actual cost. It's just the at wages payable at their actual amount. And then your manufacturing payroll account here, again, a control account. That's just your actual cost here, the actual labor rate at an hourly basis times your actual hours used. And then for your work in process, that's just your standard rate here on an hourly basis times your standard hours allowed here for whatever you're looking at here. It could be the departmental hours, or you could be looking at some specific project. Okay, and then one other thing here, just to expand on our definitions a little further here. All right, going over here, just looking at our direct labor rate or price variance, as you call it here. Again, this is where you're just expanding on the definition. You take your actual hours worked times your actual rate on an hourly basis, and you would subtract from that the actual hours worked again here times the standard rate here on an hourly basis. Okay, so that's your direct labor rate or price variance. And then your direct labor efficiency variance, that's really taking your actual hours worked times the standard rate here on an hourly basis, and you would subtract from that here your standard hours allowed here times, again, your standard rate on an hourly basis. Okay, so that's the difference here between your direct labor rate or price variances versus your direct labor efficiency variance here. Okay, one last point. Let's go over it here, just looking at our debits and credits here between our actual cost here in our manufacturing payroll and our work in process here for our standard cost. Say, for example, you were just given these numbers here and you weren't given any actual hours used or standard labor rates and so forth, but you knew the $62,115 here, that was your actual cost, as a credit here in your manufacturing payroll, and then the debit here in your work in process here was $60,000. So you know that you're going to have some variances here, and the variances are going to be what, $2,115 here, and they're going to have to be split between either your direct labor rate variance or your direct labor efficiency variances. And you could have the case here where remember, your rate variances could be unfavorable, your efficiency variances could be very favorable, or vice versa, or they both could be unfavorable or both favorable. But what you would have to know here to determine the difference between any efficiency or rate variances, you would have to know one or the other. You know that you have the debit here, $60,000. You're going to need some associated debits here in your variances here between your rate variances and your efficiency variances here of $2,115 to balance with your credit here in your manufacturing payroll account here of $6,215. So again, you'd have to know to determine any efficiency variance here, and you didn't know the efficiency variance, but you did know the direct labor rate variance, in this case is $615. You can go and add that to your debit here, or your debit in your direct labor rate variance is $615. Add it to the debit here in your work in process of $60,000. So then you can compare your debits and credits here, and you're going to see that you're going to need an actual debit here in your direct labor efficiency variance of $1,500. So just using your debits and credits here, you can go and you determine any efficiency variances here based on the difference between your credits here that you'd be coming out of manufacturing payroll, that actual cost amount, versus your debit here to your work in process based on your standard cost. Just remember the difference between this variance here that you were looking at. In this case, it was split both between the direct labor rate variance and the direct labor efficiency variance, and we had that $615 as a debit to direct labor rate variance, plus the $1,500 here to direct labor efficiency variance, and that total of $2,115 added to our debit here to our work in process of $60,000 balances with our manufacturing payroll actual cost here, $62,115. So I'm just doing a play here on your debits and credits and how you could balance them out here to determine any of your rate variances, knowing one variance or the other variance based on what's sitting in your standard cost here for your work in process versus what your actual cost would be for your manufacturing payroll. Okay, so that'll summarize our topic.